Very good morning to all of you. So we are back with another topic after a small gap. So this time we are going to cover computation of total income. In the last class, we had discussed, we had stopped with deductions, and some of you had said I had not covered a particular section that is ATU. So we'll just briefly explain that and then proceed on with the today's chapter. So as far as ATU is concerned, the reason why I left out probably I just skipped mentioning this. It is exactly similar to ATDDB. So ATDDB, we said when you have a dependent disabled person, then depending upon the disability level, that is, if it crosses 80 percentage, if the disability is more than 80 percentage, then you get a flat 1.25 lakhs. Otherwise, it is flat 75,000, right? So that's what ATDDB is about. Now, ATU is for persons with disability. So DDB and U, there's only one small difference. DDB is for dependent who's a disabled, and ATU is for the assessee who himself is claiming the disability provision. So that's the only difference. Otherwise, there's nothing else to remember independently. Whatever is ATDDB is also ATU. Only there it is dependent disabled. Here it is assessee himself is disabled. So that's the only difference. When you claim ATU, you're of course not eligible for ATDDB. So that's the only point here. So that's it for the section which we have skipped earlier. Now we'll move on to the current section. So current chapter, we are going to cover computation. So basically in the earlier classes, you have covered advanced tax, TDS, TCS, details of return filing. So what are the sections that are used for filing a return of income? All this have been covered in the earlier classes. So now we are going to combine all. So whatever you have learned over the months together, you would have studied heads of income, exempt income, clubbing, set off carry forward, advanced tax, TDS, TCS, return filing, all these chapters, whatever you have studied so far, we're going to combine and see how do you actually compute the total income and calculate the tax liability. So that's what we are going to discuss in this particular section. So in this particular session. So in this session, we are going to discuss about the computation of total income. So when you talk about this word computation of total income, there are various steps probably you need to consider, or in turn, you can even specify that the steps that you will be actually following. So I don't think there is nothing new that I'll be sharing in this particular slide, but probably I'll give you an idea on what are the steps process that you need to follow to make sure that you're not skipping anything, that you're not missing anything in your examination. So when you're given a problem on computation of total income, what are the things that you need to follow? How do you actually proceed as far as a problem is concerned? How do you disclose? How do you present it in your exam paper? So that's what we are going to discuss here in this particular session. So we are starting with a summary of the steps. So this is the overall chapter itself. The first step is, of course, determining the residential status. So just imagine your chapter structure, whatever you have studied in ICAI. Same thing applies to Income Tax Act also. So that's the chapter order in which you have studied. So initially you would have just studied about determining residential status. Initially, you would have just understood what is income tax, what are the types of provisions, and what are all the components of income tax. All that is okay. After that, you would have studied the first chapter, which is regarding the provisions. You would have studied residential status. So you would have the first step of computing a total income is to understand what is the status of the assessee. Is he a resident or is he a non-resident? In case of individual, is he an ordinary resident or not ordinary resident? So we'll see that. So you'd have already studied. We'll just recap a little bit in the next slide. And then the second step is determining the heads of income. In this, there are two steps. The step 2 is classification of heads of income. So once you have given a list of income, say you have salary, you have house property, you have interest income, you have dividend income, you have lottery income. What do you do this? You put it into the respective bucket. You need to understand which are the heads under which each of the income will be taxable. So that is step 2, right? So we are going to classify the heads of income. And then we are going to compute. What do you mean by compute? You're going to compute the income under each head. You would have studied various things under salary, treatment of allowances, treatment of perquisites, right? So salary, allowance, perquisite. You'll be computing all this together as salary income. And then you will have house property. You'll determine the gross annual value, net annual value, standard deductions, and then compute income from house property, right? The third thing, business or profession. What will you do? You will compute the profit. You will take the profit as per the books of account. From there, you will allow, disallow various sets of income, and then compute business or profession. So the next one we are going to discuss about capital gain. What do you do in capital gain? Again, you compute gross sale consideration, net sale consideration. If there are any exemptions available, you take that into consideration. Finally, you arrive at the taxable capital gain in terms of long term and short term. There are various categories under long term itself: regular long term, specific long term, that is your 112A. Similarly, in short term, you have regular short term, specific short term, that is your 112A. So that's what we'll be classifying. And then you have other sources. So all this you have studied, right? You would have studied how to compute under salary, how to compute under house property in each of the sets. So that is the third step, that is computation. Moving on, we need to club others' income. So under the respective head itself, if we are responsible for someone's income, we have studied in our clubbing of income chapter, whose income do we club? We club spouse income, minor children, son's wife, right? For in-laws, son's wife is covered. And then you are only transferring the income, not transferring the asset. So these are the things that are considered as clubbing of income. So you include that part of this clubbing of income. So next is, so we saw first step, second and third. This is fourth step. Fifth step is setting off and carry forwarding of losses. So you actually adjust the losses in the manner that we have discussed in the earlier sessions. And then based on that, you compute your gross total income. So giving impact to all of this, you get your gross total income. On this gross total income, you give impact to deductions under Chapter 6A. We have discussed this also in detail. So you give impact to all the deductions under Chapter 6A, right from Section 80C to 80U. Whatever provisions it is applicable, it is eligible, you give that provisions. And then eighth step is what happens automatically: gross total income minus your deductions will become your net total income. So this net total income will be rounded off to the nearest 10 rupees, right? So this net total income, you will apply rates on this net total income. What do you mean by rates? For each of the assessee, you have independent rates. So individual, a partnership firm, AOP, BOI, a company, LLP. For all this, you have different rates, right? So as far as your intermediate exam is concerned, you're only focusing on individuals in HUF as far as this computation is concerned. So you all know what individual HUF tax rates will be. Anyways, we'll refresh it in the subsequent slides. So ninth step is applying the tax rates. So next, 10th step is if you are eligible for some of the rebates. So again, we'll discuss this. We'll recap. We'll only recap because I'm sure you all would have gone through this in the respective classes. So we're only going to recap so that you have a fresh knowledge, fresh mind on whatever you have studied. So it's just to help you refresh your memory. So we'll discuss about rebate. After that, this is the straightforward and most simplest provision probably. Just apply 4% on whatever tax liability you arrive, right? So that is the straightforward provision that you have for health and education cess. Next step is 12th step is identifying whether applicability of alternate minimum tax is there. This you would not have studied. We will only be studying at this point in time. So we will be studying about what is alternate minimum tax, how is it computed, and all that we'll be studying in this particular thing. 13th one, concession rate. I'm not sure whether you would have studied in the chapter of tax rates. So anyways, we'll be studying it in detail. This section also, we will be studying in detail in this particular session itself. So in this class, we'll be studying that. So step 13 is check the applicability of concessional tax rate. So you check applicability of these two, whether alternate minimum tax is applicable for the assessee or concessional rate could be opted for the assessee. What is concessional rate? What is alternate minimum tax? Let's please hold on for a while. We'll definitely cover it in detail. And the next step, that is your 14th step, is your tax payable and refundable. So after doing all this, what is the main objective? You identify how much should you owe the government, right? How much should you pay the government? How much should the assessee pay the government? So how much does he owes, or is there something that government has to refund to the assessee? That's what we are going to determine. So based on all this, you finally get your tax payable refundable, which is your 14th step. On this, you might be eligible for some of the credits. You would have just studied in the earlier session, a couple of sessions earlier, where you would have discussed what is advance tax, how it is paid, when it is applicable, and provisions of TDS for salary, for contract, for professional. All this you would have discussed. And then you would have also discussed the basics of TCS, because the details of TCS is only in final. In intermediate, you would have just studied the basis of TCS. So if there is any credit through TCS, you take that also into consideration. After this, I'm sorry for the numbering error here. So this is 14. So basically, this is 14. This is 15. So you adjust for the tax. Finally, the net thing is what? Payable to the government or refundable to the government. So you determine what is the tax credit that you need to adjust on that, the net amount, whatever is the final amount, you finally pay it to government, or your due, the assessee is due to receive from government. So these are the 15 steps that needs to be considered while doing it computation. Number 15 looks large, right? So it looks like as if we need to follow so many things in a particular question. Definitely not. These are all simple steps which you would have already studied. All this combined together is what computation. Just for the sake of reference and ease of understanding, we are naming it as steps. Otherwise, it's a methodical process which everyone should follow while computation. So by numbering it, there are 15 steps. Otherwise, it's a methodical order of the chapters you probably studied. That's all it is all about. Okay, we'll go into some of the refreshing the provisions. Before that, we'll understand what do you mean by computation of total income, right? We said 15 steps are there. Now, I could be an individual, right? I could be an individual. I could also be a partner in a firm, a director in a company, a member of HUF. I could also be responsible for someone else's income. So all that will be there, right? So when you say individual, what are all the incomes that you need to cover? That's what we are going to discuss in this particular slide. So what are all the income? First is straightforward. All the incomes that we have discussed, 5 heads of income, whatever in the 5 heads, whatever we have classified and computed. Step 2, step 3. Remember the term? I said linking each of the provisions that you have studied earlier, so that it helps you keep your memory longer, much longer, probably for a very long period, even after exams. It will stay in your mind if you're trying to link the provisions. So we said about 5 heads of income. In heads of income, there are 2 steps in computation. Step 2 is classification. Step 3 is computation. So that is what we are talking about, personal capacity. So next, you might be a partner in a particular firm. So what are the incomes that is applicable when you're a partner in firm? One is you might be getting a remuneration. So as a chartered accountant, let's say I'm a practicing chartered accountant, earning remuneration from my partnership firm, earning bonus from my partnership firm. So this income, though it is salary, though it is in the nature of salary, or you call it salary, it is not treated under income from salary. It is treated as business or profession. Why? Because there are restrictions on how much you can take as remuneration, right? In business or profession, you would have studied under section 40A, that is 40 caps A. 40A is the section. In 40A, you would have studied how much provisions you are eligible. So what is the total liability, total remuneration that you can draw from your partnership firm? So that provision, whatever you have discussed in section 40, is what your remuneration is eligible. So though you have taken, let's say you have taken 10 lakhs, you're allowed only to claim what has been allowed as salary or remuneration from that particular firm. So that is what we would have studied in section 40. So this will be treated under business or profession. Similarly, you would have also studied provisions for how much of interest is allowed on capital. So that is also covered under business or profession. So these 2 incomes, that is your salary and this is covered under PGBP and not under salary or other sources. Though it is interest, it is not other sources. Though it is salary, it is not taxed under income from salary. So that's what is there. And as I just informed, these 2 incomes is only taxable to the extent it is only taxable to the extent it is allowed in the firm, because otherwise it will become a double taxability. Both the firm will also pay the tax on that, and the partner will also be paying tax on that. So that is why we are calling it as only to the extent allowed in the firm. Let's take a small example. Let's say the profit of firm is 10 lakhs. Allowable partnership remuneration is 2 lakhs. So what would have been taxed under partnership firm is 8 lakhs, right? This 2 lakh is taxable in the hands of partner, right? Now, let's assume whatever he had claimed in partnership firm is 2.5 lakhs. It's 2.5 lakhs. Now, what happens is what is allowed in partnership firm is only 2 lakhs, right? As expenditure. So, which means on that net only they're paying tax. Now, this 50,000, whatever we are talking about in this 50,000 is not allowed in the computation. So, this 50,000, if it is also taxed here, it is taxed both in the hands of the firm and in the hands of partner, which becomes double taxation of the same proportion. So that is why it clearly says it's only taxable to the extent it is allowed in the firm. So that's the point there. And share of profit, you all know it is exempt under section 10(2). So where your share of profit is actually exempt in the hands of the partner. So it is not taxable in the hands of the partner. Reason again, this 8 is already taxed, right? Now this 8, if split it into two partners, 4 and 4, I cannot tax it again because there is already a tax incidence on that 4, right? On that 4, there's already a tax payment made. So it is not doubly taxed. So share of profit is exempt for this reason only. So this is what we are meaning by remuneration taxable under PGBP. Interest is also taxable under PGBP. And then your share of profit is exempt in the hands of partner. Share of partner of a partnership firm, not an AOP or BOA. And then member of HUF, and that is also straightforward. Any member that you receive, any income that you receive from HUF is exempt. Reason, same concept what we discussed in firm. HUF has already paid tax on that income, so I will not pay again. So that's the thing. And if there is something called impartible asset, what do you mean by impartible asset? Impartible is nothing but which could not be partitioned. So it could not be partitioned. In that case, if it is held by a particular person and it could not be partitioned, whoever is actually holding on to that, the real owner, whoever is holding on to that, or the eldest member will directly be taxable of that particular income. So that is what we are discussing about member from HUF. And finally, the clubbed income, we have already discussed this in detail in a separate session, where it could be a transfer of income without asset, revocable transfer, spouse income, minor children, son's wife. So these are all the incomes that shall be clubbed. So clear with respect to this. So these are the two things that we are going to discuss. There's just question. I'll just answer one question. Yeah, Manish. This 50,000 will not be taxable in both. It will only be taxable in the firm because whatever the partner is paying is only on 2 lakhs. He is not paying on 2.5 lakhs. In the example that we're discussing here, this 50,000 will not be considered in the hands of partner. It will only be taxed here because this 8 includes this 50,000. So whatever this 10, let's say initially when you are working on a partnership firm, I'll just do a work. Let's say your profit is 12.5 lakhs, right? You less remuneration of 2.5 lakhs. Now your profit is 10 lakhs. On this 10 lakhs, you go and compute how much remuneration it is actually allowed. Let's say allowed remuneration. I'm sorry here. It is. I'll just write it again. Profit is 7.5 lakhs. There is already a remuneration considered. So this remuneration I'll add 2.5 lakhs because whatever I provided is not allowed. Whatever I'm eligible only is allowed. So I add this 2.5 lakhs, arrive at 10. Now on this 10, I less whatever is eligible remuneration, which is 2 lakhs. So 8 is taxable profit, right? So I pay tax on 8. I, in the sense, the firm pays tax on 8. Now the partner will only report 2 lakhs because this 50,000 is already inbuilt into this 8 lakhs. So which means the 50,000 firm has paid a tax. So only on this 2 lakhs, the partner is paying. So that's what the idea behind this partnership firm. Okay, so we'll move on to the next uh, thing. These steps, we just said that you're going to recap, you're going to refresh whatever you have studied right now. So now we are going to recap. The first one is about individual and HUF. We said determining residential status. What do you do when you are an individual HUF? Individual HUF, we are not going to specifically state the provisions, what is basic, what is additional condition. We're not going into that, but we're just going to refresh your memory. So the resident, there are two resident status. One is ordinary resident and non-ordinary resident, not ordinarily resident. So OR and NOR. And then you have a non-resident. In Finance Act 2020, there is a new provision that is inserted, a concept called deemed resident. So deemed resident is always a not ordinary resident. So deemed resident is always a not ordinary resident. So what do you mean by a deemed resident? We will just discuss it a little later. Basically, whosoever has a foreign income, right? Whosoever has a foreign income, that is an income not generated from India, foreign income sources, if there is more than 15 lakhs and that income is not taxable in that country, only for them this deemed resident is applicable. I'm not going to go into the specifics of this provision because you'd have already studied that. So to just recap, an individual or HUF is going to be classified as resident and non-resident. Resident is again subclassified into ordinary resident and not ordinary resident. In Finance Act 2020, there is a new provision which is called a deemed resident, who will always be a not ordinary resident, who will always be a not ordinary resident. For everyone else, there is only two classifications, resident, non-resident. For company, firm, AOP, local authority, artificial judicial person, for all of these, there is only two classifications, resident and non-resident. Only for HUF, you have individual and HUF, you have three categories. That is ordinary resident, not ordinary resident, and non-resident. So you have three categories. And for HUF, you determine this ordinary, not ordinary based on Karta. So this, to determine whether an ordinary or not ordinary resident, you determine the status used in Karta. For individual, it is straightforward. Based on that individual, you determine. For everyone else, it is resident, non-resident. And this deemed resident concept is only for individual, not for HUF. It is only for it is only for individual, not for HUF. So that's a resident step one of residential status. And then we said you need to classify into, there are 5 heads of income. You need to identify which is the heads of income. And when you're talking about identifying and grouping it, you'll have to understand how does a particular income get classified into that particular head. Now, to understand how does a salary comes under the class salary. So there is something called charging section, which you would have studied in the first chapter of introduction, which basically provides the power to income tax to tax a particular income. So Income Tax Act says this income is taxable under this head. This power, this authority to charge a particular income to tax, that is what is called a charging section. So you have section 15 for salary, 22 for house property, 28 for business or profession, 56 for other sources. So there are specific sections which says these are the incomes will come under this particular head of income and taxable. So this is what you're calling by charging section. And then you will have a deeming provision in some of the things. So for deeming provision, we can take an example of bad debts. So bad debts, whenever you're making a bad debt, right? Whenever in a business, when you're making a bad debt, we saw section 41, right? We also saw section 59 in income from other sources. So these are called deeming provision, which means this is deemed to be an income. So when you say a bad debt, you're not able to recover a particular debt. You're treating it as a bad debt. Over a period of time, let's say after 2 years, you're actually receiving that income. The debtor which you thought is a bad debt, now you're receiving it again. So now, since you have already claimed it as bad debt, when you're receiving it again, you treat this as deemed income. So that is what discussed in 41 and 59. Both says there are certain provisions which are deeming provisions, which will be deemed to be an income, or in some cases deemed to be an expenditure. So these are called as deeming provisions. So all this have to be considered, right? So applying these provisions, you compute. So applying these charging and deeming provision, you compute income under each head. you also consider exempt income, because you are not supposed to include in any of the heads. You're supposed to exclude. Some of the exempt income is wholly exempt. Some of the income is partly exempt. When you say wholly exempt, agriculture income, share of profit, all these are called wholly exempt. The complete income is exempt. But partially exempt, you have house rent allowance, leave travel allowance, all these things are partially exempt. Not the whole income, or the whole income is not exempt. Only a part of it is exempt, right? So house rent allowance and leave travel allowance is some of the examples of that. And finally, each head will have certain expense to be allowed as an expense. House property, you have municipal taxes paid as an expenditure. Interest can be claimed as a deduction to an extent. With respect to your business or profession, there are various business expenditure that you can claim. In income from other sources, we said about expenditures on dividend, interest expenditure, all this we studied about various restrictions. So whatever expenditure is allowed to be claimed under that particular head. So in capital gain, you have brokerage, right? So brokerage can be claimed as an expenditure. So all this expenditure which are allowed under the act, alone will be taken care of. So all this is included to arrive at computation. So whatever you have studied under each chapter, each head of income, salary, business or profession, capital gain, other sources, house property, all this you calculate, you compute independently. Each of the head you compute independently and arrive at income as per the head. So that's the thing. And the next one, step we said classification and computation we have discussed. So step 4 is clubbing of income. When you say clubbing of income, we have already discussed. It is only transfer of income without transferring the asset, transferring the income without the asset, transferring the asset which is revocable, right? So you call it as revocable transfer. So we discussed about revocable asset. So this revocable asset, and then you're transferring to your spouse, minor children, or son's wife. So all this is called clubbing provision. So all this is covered under clubbing. So these three income you take, classify, you compute, and then include clubbing of income. With this, we'll have to discuss about set off carry forward. The next step 6, we said it is set off carry forward of losses. So we said there are three natures: inter-source, inter-head, and carry forward and set off. We have already discussed. I'm just recapping with the particular table that we studied earlier, what is allowed under each head. So we have studied in the earlier session. So we need to know which of the income can be taxed, which can be adjusted with other incomes. For example, business loss, a general business loss cannot be adjusted with salary. It can be adjusted with any other head. Similarly, long term can be adjusted only with long term, right? So this is the brief summary. House property, maximum of 2 lakhs only can be adjusted. Beyond that, it cannot be adjusted. So these are the provisions of set off carry forward, which we have already studied. So this slide will give you a recap, a refresh on what we have studied with respect to house property, with respect to setting off and carry forwarding of each of the losses. Okay. Next, we'll move on to the step 7. We said it is application of rates, right? So how do you determine what are all the tax rates applicable? So as an individual or an HUF, the basic tax rate is up to 2.5 lakhs. There is no tax. Then up to 5 lakhs, it is 5%. Then it is 20. And then above 10 lakhs, it is 30%. Now, there are provisions for senior citizen. When we say senior citizen, the important keyword is resident. We even stressed earlier. So only a resident can be a senior citizen. So there is no point in even looking at whether a person will be a senior citizen or not for a non-resident. It is not at all relevant. So it is only for resident who is aged 60 years and above, but less than 8 years. For this person, for this category of assessee, the basic limit is not 2.5 lakhs. It becomes 3 lakhs, right? So the 5% is from 3 lakhs to 5 lakhs. So that's what is for a senior citizen who's above 60 but less than 80. For a very senior citizen, if above 80 years, there is no second slab also, which means there's no 5% also. Straight away from 5 lakhs, they are taxable at 20%. So that is for senior citizen, very senior citizen who's above 80 years. Now, there has been a clarification way back, like 5 years back itself. What do you mean by what date should you consider for calculating 60 and 80? Now it said if your birthday falls on 1st April, that person also should be included, though you must be completing 60 years on 31st March. There was a separate circular to say include persons whose birthday falls on 1st April also. So for short understanding purposes, a person who's born on or after 1st April 61, who's born after 1st April 61 is not a senior citizen. Who's born till 1st April for your relevant year, for this year which you are talking about, financial year 21, before 31st March 21, they should have completed 60 years. So for a person who was born after 1st April 61 is not a senior citizen. So you no need a calculator, you no need to do any mental calculation. You can just keep this date in mind. If a person is born after 1st April 61, then they are not a senior citizen at all. So only with respect to persons before 1st April 61. Similarly, 41. 1st April 41, they'll be considered as very senior citizen. So anyone born prior to on or before 1st April 1941 will be very senior citizen. 1st April 1961 will be a senior citizen. These are just small numbers that you can remember to easily conclude whether they are senior citizen or not. But for practical purposes, mostly in questions in your examination, the age will be specified. So there will be no calculation required. It will just say 62 years, 65 years. It will not even ask you about whether it will not let you calculate. It will actually, the question itself will specify the age by itself. So this is just for remembering purposes. In case if required in some of the multiple choice question or something, you can use this. Now, for an individual, for a person who's above 50 lakhs, there is surcharge involved. So these three, that is 1 crore, 2 crore, and 5 crore limit was bought only in Finance Act 2019. So for a person between 50 lakhs and 1 crore, it is 10%. Above 1 crore, it is 15%. Up to 2 crore, 2 to 5, it is 25%, and then it is 37%. So now, if you have an income under these two sections, that is 111A and 112A, because they have subsidized rate, right? 111A has 15% of tax rate. 112A has 10% of tax rate. So you cannot have a surcharge which is higher than your tax rate itself. My tax rate is 10%, but my surcharge is 37%. That's not right. So what income tax says is, if you have an income under section 111A and 112A, to that extent, your surcharge is restricted to 15%. That is 15%. So there is no 25 and 37 category for the income exclusively gained in 111A and 112A. So that is the provision as far as surcharge goes. With respect to a new provision in Finance Act 2020, an optional rate has been introduced, so 115B, which we'll see in the subsequent slide. So I'll just see if there is some question answer. Yeah. Some of you have asked me to explain what not ordinary resident means. See, not ordinary resident, you would have already studied the residential status conditions. With respect to basic condition, you must satisfy at least one condition to become a resident. If you are satisfied one of the basic condition, then you go into additional condition. When you satisfy the rule of additional condition, then you will be called as an ordinary resident. Otherwise, you will be called as a not ordinary resident. So basically, there is a 2 additional condition, which is 9 out of 10 years you have been called as a non-resident. You have stayed in India for 729 days or less. If you have basically satisfied that additional condition, then you will be called as a ordinary resident. So to determine an ordinary resident and not ordinary resident, you'll have to go through the provisions of additional conditions mentioned in your residential status determination. I'm not going to go into that specific. So because you'd have already studied, you can always recap at any point in time in that relevant session, whichever has given you this knowledge of residential status and ordinary residential status. Similarly, how is an income taxable, whether received in India or not in India and all, that is also covered in detail in your residential status chapter itself. What income is taxable in India, when it is taxable in India. So I'm not going to that. We are going to only focus on completely calculating the income of the overall head of income. So specific doubts of specific heads of income, you can always refer to that specific classes just to save time. So to give importance to this chapter, we do that. As far as surcharge goes, we said it is applicable. The surcharge is always applicable on the total income, and there is a slab available for surcharge. In case of surcharge, if it is surcharge is related to your long-term capital gain, specific long-term capital gain under section 112A, or specific short-term capital gain under section 11A. So in these two sections, if you have earned income, for that income, your surcharge cannot exceed 15%. It is restricted to 15% for that income alone. Let's say I have 80 lakhs of income. The entire 80 lakhs is only from these income, long-term capital gain and short-term capital gain. To that extent, that is whatever surcharge I'll be charging is restricted to 15%, irrespective of my type of income. Because this category, 50 lakhs to 1 crore, it is 10%. So you'll only be charged 10%. But the question comes when your income is above 2 crores. When your income is above 2 crores, so your total income is greater than 2 crores. In this case, what happens is, your surcharge will be applicable only up to 15% and not 25%. So that's what we are saying. Your surcharge is only with respect to your, is restricted only with respect to short-term capital gain and long-term capital gain. For other sections, it is not restricted. So for other section, if your income crosses 2 crore, you can always apply 25%. So that's the point as far as your income computation goes. So that is with respect to surcharge rates. Okay, we'll come to optional rate. So there is an optional rate scheme which is provided in Finance Act 2020. So it's a very new amendment. So your question, this has to be computed only when your question openly specifies that you need to choose between two sections, or it is silent. In some of the sections, exams exercise question will probably say 5 BAC. So in that case, this will need not be computed. But if you are not given a specific exclusion, you need to compute. This section goes. This section is an optional section. When you say optional, if you think it is beneficial, that is, if the assessee thinks it is beneficial to the assessee, he can opt to this section. Otherwise, it is not applicable. It will not be opted. So it is whichever is lower. I compute tax under normal provision. I compute tax under 115 BAC. Whichever is beneficial to me, I take that into consideration. So that's this provision is about. So what is the income tax rate? So this is the income tax rate. So basically, there's a step of 2.5 lakhs. In earlier old rate, we saw 2.5, then 5, then 10, right? And then about 10. So that's all we have. Here it is step of 2.5 lakhs. First to 2.5, next to 2.5, next to 2.5. So for every 2.5, there is a change in rate. Above 15 lakhs, there is a flat rate. So what is the rate? Up to 2.5 lakhs, of course, there is no tax. 2.5 to 5. And then 5 to 7.5, you have 10%. So instead of 20, you're going to only pay 10. 7.5 to 10, instead of 20, I'm going to only pay 15. 30 and above 15, right? So it is same, right? So this is going to be my benefit. Whatever subsidized rate I'm getting in this area, right? In this area, this is only going to be my benefit. So this subsidized rate in each of the slab is only going to be my benefit as far as this goes. Now, for opting this provision, there are two categories. One is an assessee with business income. Another is an assessee without business income. So for a person with business income, once he opts, if I'm opting, if say an assessee is into business, he's opting for this new scheme, he mandatorily have to follow for the other subsequent years. So once exercised, it shall apply for subsequent years. But in case if he's withdrawing, he feels that it's no more beneficial to me, I'm going to withdraw this year, forever in future, decide again. So it is a one-time option. You choose, you start to follow. In case you are withdrawing, you are no more eligible to choose under this particular provision. So that is with respect to 115 BAC with business income. So person with business income can choose only once. Once he has decided, it is automatically applicable for every year. Every year, in case if he is withdrawing in some particular year, he is no more. He can no more this in future. So this is usual to choose this rate. So now this rate, whatever we are discussing about, we said for others, what is there? If you have a business income, we said it is a one-time choice. For others, it is free. I apply this concessional provision in this assessment year 21-22. I am not using this for the next year, assessment year 22-23. I am again choosing for 23-24. So I can do whatever I want. I can choose 1 year, I can ignore another year, I can again choose another year. So there is no restriction as compared to what you have when you're having business income. So when you have business income, it's a one-time choice. If you do not have a business income, it's a yearly choice. It's a yearly choice. So that's what is important here. You would have studied TDS provisions whereby you'll have to intimate your employer, you have to intimate your people, what are all other incomes you have. For example, TDS and the salary will be deducted by the employer. You feel that you wanted to choose this optional concession. You need to inform the employer, asking him to deduct under concessional rate. So employer will not automatically calculate and see which is beneficial and all. It is not the role of employer. It is not the duty of employer. So it is the duty of employee to intimate the employer or any other person saying that he is going to choose this optional rate, new optional rate for his particular return filing. So he has to state it, he has to specify it to the employer or the person who's supposed to deduct tax, right? So that is what this is very critical in salary alone, because in salary, you're going to compute your actual tax, average it, and deduct it over the year. So this is very important salary that you tell your employer that you're going to choose optional rate and not the regular rate. So this is what happens. So this has been clarified through a provision, through a circular on 1st April 2020, saying that it is the duty of the employee to report to employer on what rate he is going to follow. Is he going to follow the new rate or the existing slab? So that is the role of the employee to disclose it to employer. Okay. These benefits, right? Instead of 20, 10%, 15%, so lower rate. This lower rate doesn't come free of cost. You need to sacrifice. An assessee needs to probably sacrifice certain things to get this. We can simply call it as conditions. So there are some conditions if you wanted to choose this concessional rate. What are those conditions? In one single line, if you wanted to tell, basically you are not eligible for any deductions or allowances, regular deductions. You are not eligible for any regular deductions or allowances with respect to this new provision. So what are the things you are not specifically not allowed? Leave allowance and HRA. So you can't compute how much is exempt. So there is no, I live in Chennai, I live in Mumbai, so 50% of my HRA, 50% excess of rent paid, 10%. So no, whichever leaves falling, nothing needs to be computed. Similarly, for leave travel allowance, you need not compute any number of days and calculate how much of leave travel allowance is exempt. So basically, if you wanted to choose optional rate, whatever you have received as leave travel allowance, whatever you have received as house rent allowance is fully taxable. So there is no exemption. So the section 10 exemption for leave travel allowance, house rent allowance, special allowance for office duties, all this is not allowed under your new provision of 115 BAC. And then exemption of minor children. How much is exempt for minor children? We discussed section 10 clause. Then any daily allowance with respect to your MPs and MLAs. Just a second. So any deductions to your MPs and MLAs is also not allowed as an expenditure. So that is what is discussed. And then we have to discuss about depreciation. So before depreciation, you have standard deduction. Standard deduction under section 20, under section 16 is also not allowed. So that is also not allowed with it. So the 50,000 is also not allowed. So that's what is there. And then you have interest on self-occupied property. With respect to interest on self-occupied property, you are not allowed to claim under this provision. Your interest on self-occupied, whatever you are discussing, is restricted with respect to 2 lakhs, right? You would have studied in house property that your self-occupied property interest, you can claim up to 2 lakhs. That is not allowed under this particular provision. Then you have interest on, if it is a let out property, you can claim. If it is a self-occupied property, it is not allowed. Why there is a deviation between self-occupied and let out? In let out, you also have income, right? You compute your net annual value, all that, and then claim interest. So it is allowed. For self-occupied property, you are only claiming the loss, so it is not allowed. And then depreciation. Regular depreciation is allowed. You would have studied something called additional depreciation and additional depreciation allowance. So that depreciation is not allowed. So basically, it is only for new assets acquired during the year. For manufacturing entities and selected entities, you can claim additional depreciation. That depreciation is not allowed under this new provision. Any deduction under scientific research, any extra deduction. So you are already eligible as an expenditure. If you are claiming an additional deduction under scientific research, that also is not allowed. Then your specified business, that is section 35AD, which talks about investment linked. Even your capital expenditure can be claimed as an expenditure. So that is discussed in 35AD. That provision is also not allowed. Similarly, expenditure on eligible agriculture product, I guess it is 35CCC. So that is also not allowed. Expenditure on family pension. So in income from other sources for family pension, whatever expenditure eligible, what is eligible? 1/3 or 15,000, whichever is higher. So that is also not allowed. So the 1/3 or 15,000, whichever is lower, is also not allowed as an expenditure. And any chapter 6A deductions. So it's not allowed. So basically, you can't claim 80C, 80D, 80EA, all those things. You can't claim anything under chapter 6A. You are only eligible for 2 provisions. One is your National Pension Scheme, NPS, under section 80CCD. In 80CCD, there are 2 contributions, employee and employer. What you are actually allowed is only employer. You are not allowed for employee. So that is why we are saying employer NPS, which is 80CCD2. So that alone is eligible to be claimed. And then additional employee cost. Additional employee cost is 80JJAA. So this is also allowed. Any other deduction, 80C, 80D, 80DDB, 80TTA, TTB, nothing, no other provision other than this 2 is allowed as a deduction if you are claiming optional scheme. Similarly, adjustment of losses with respect to carry forward losses, if it is related to depreciation loss of this provision, that is your unabsorbed depreciation because of additional depreciation, because of depreciation allowance, that is also not allowed to be adjusted. So your regular depreciation loss can be carried forward. Your regular business loss can be carried forward. But if the depreciation loss is because of this additional depreciation, then it is not allowed. Similarly, loss from house property cannot be carried forward and adjusted. So that these are the sacrifices. These are the sacrifices, or these are the things that the assessee should not consider if they have to claim this new provision of optional rate under section 115 BAC. So this is what is discussed here. So we'll just answer some questions of this new provision and then move on. I guess some of you have said my screen is stuck, maybe due to poor connection. Just give me a second. So yeah, hopefully the video and audio is proper right now. I'm trying to make sure that the internet is stable. I'm sorry for that, for the small glitch in between. Okay, and some of you have wished Happy Teachers Day. Thank you for the wishes. Okay, whether this is optional, yes, this is completely optional. It is not mandatory. So as an assessee, let's say I am the assessee, I will compute my tax under normal provision. I'll also compute under this special provision of 115 BAC. Whichever is beneficial, I take into consideration. So that is the provision. So it is completely optional. And for an individual with no business income, for every year I can decide. This year I can say yes, next year I can say no. So every year I can repeat this comparison of whether it is available or not available, and then take a call. So it is completely optional. And if you do not have a business income, you can take this option every year. 1 year you can take, 1 year you can ignore. So this can go on. But if you have a business income, it is a one-time option. Once you have taken, you have to follow it for the regular of year. In case if you are coming out of this option, then you lose the option of taking it again in the future years. So that is what with respect to if you have a business income. And with respect to depreciation, Sanjay, depreciation is allowed. Regular depreciation is allowed. Your regular calculation of depreciation on WDV, on new assets, all that is allowed. You would have additionally studied something called additional depreciation for specific industries. So that depreciation is not allowed. So that is what is there. Okay, so thank you. So that's the questions that we have. So we'll move on to the next slide. Moving on to the next slide. So we are moving on to the next step. Before getting into the concept of rebate, the next step, I wanted to briefly explain you on this marginal relief concept. You would have already studied this. So basically, marginal relief happens when your surcharge is higher than the income that you have additionally earned. Let's say my income is 51 lakhs. I'll have to pay surcharge for the whole tax, for the entire tax, right? So sometimes my surcharge could be more than 1 lakh for an income of 51 lakhs. I only earned additional 1 lakh. Till 50 lakhs, no surcharge. I only earned 1 lakh extra. I only earned 1 lakh extra, but my surcharge is more. So for this concept, you have a concept called margin relief. I'm not going to explain it in detail. So these are the steps to compute margin relief. So first you have to calculate tax on the total income under normal rates. So without surcharge, whatever is the applicable surcharge, you'll have to calculate in normal as you generally do. Then you'll have to take the previous limits. For example, if your income is 51 lakhs, you'll have to compute tax for 50 lakhs. If your income is 1 crore, 1 lakh, you'll have to compute income for 1 crore. Now you'll have to calculate 1 minus 2. So that is the third step. So you calculate excess tax, how much excess tax you are paying. And then you calculate excess income. That is nothing but your actual income minus the base income. So this you'll have to calculate. Finally, the 3 minus 4, whatever is if it's positive, it is a margin relief. So to that extent, you need not pay surcharge. So this is there. I hope you would have already studied that earlier. So these are the simple steps to compute margin relief, 5 steps, which will give you how much of margin relief is applicable. So that is all about margin relief. We'll move on to the concept of rebate, right? Rebate under section 87A. So that is the next step. After you apply the rates, you'll have to go to this rebate of 87A. In this 87A is applicable only for resident individual. It is not applicable for non-resident. And it is only applicable if your income itself less than or equal to 5 lakhs, which means you must fall only in the 5% slab. The 10, the 20, 30 and all should not be applicable to you at all. What is applicable is only this 5% slab. So your income, total income is not exceeding 5 lakhs. So in that case, only then it is eligible. So you're eligible up to 12,500. So it is my actual tax or 12,500, whichever is lower. So I can claim to that extent with respect to your income tax rebate that you can claim. And you'll have to consider one important aspect in this. The important aspect is it is not applicable for long-term capital under section 112A. So there, the tax rate itself is only 10%, irrespective of the income, right? So on this income, you are not supposed to have any rebate. So if you have an income only in long-term, to that extent, if your income long-term capital gain is there, you are not eligible for this rebate. So your total income should be less than 5 lakhs. If you have a tax on long-term capital gain, you cannot claim rebate on that. Only on the balance income you can claim rebate. So that is how you need to compute rebate. So basically, let's say I have an income of 4 lakhs. out of which 3 lakhs is my long-term capital gain. So here would have applied 10%, right? Flat 10% on this. So that is 30,000. So this 30,000 I cannot use for rebate. I cannot use for rebate. If there is any tax on this additional 1 lakh, if there is any tax on this additional 1 lakh, on that alone I can claim rebate. Let's say that in that 1 lakh, I'll have to pay some 5,000 rupees tax. That 5,000 I can claim as rebate. So it's only on income above your long-term capital gain. So next, moving on to it, we'll discuss about finding out alternate minimum tax. So we were talking about alternate minimum tax, and we said we'll be discussing it in detail in the subsequent slides. Before alternate minimum tax, yeah. So for margin relief, I'm not going to go into the example. I'm sorry, because you would have already covered under some other chapter in your tax rate chapter. So you can always refer to that. So I'm not going to go into the specifics of margin relief. I'm only giving you a shortcut steps procedure on how to actually do it. You can always refer to your earlier section. If some problem insists, and then probably we'll work upon an example. And Vijay has asked whether rebate is applicable for 115 BAC. No, I'll anyways cover it now. So as far as this 115 BAC goes, you cannot claim rebate. So in this rebate, it is not applicable for this 112A. In this new section also, you are not eligible for your rebate. So this rebate is a common thing for all the individuals. So up to 5 lakhs, irrespective of the model you are using, it could be your 115 BAC or whatever it is. Your rebate is applicable. It is not only applicable on your 112A. As far as 112A goes, you cannot choose your rebate. Otherwise, you're eligible for rebate. So rebate is available for both the new optional scheme and the existing scheme. We will just discuss about what is not available for optional scheme. So this optional scheme, some certain things are not actually applicable for this optional scheme. After this alternate minimum tax, we will discuss that independently. So moving on to alternate minimum tax, we will have to go to this. We have to understand this concept. First concept is there could be a situation where I am taking some of my business as the specific profit linked or investment linked deduction, or it is eligible for a deduction under section 10AA. So where I pay zero tax, my entire income, I claim 100% deduction on the entire profit, which means I pay zero tax on that particular portion of income. So if I have a business which is falling under this section 10AA, my entire business income is claimed as a deduction. Let's say my 100% of income is claimed as a deduction, then I will actually pay zero tax, right? But government has regular expenditure across the year. The very purpose of claiming advance tax, TDS, TCS, everything is to meet out your government's expenditure. They need to invest on infrastructure. They need to spend their regular expenditure. They need to pay salary to their employees. So all these central government or have to spend on so many aspects on a regular basis. They cannot say this many business have got zero tax, so they have not paid me tax. To that proportion, I'll reduce the expenditure. They cannot do that. So the expenditure of government there must be regular and consistent. So to help this, government has come out the scheme of alternate minimum tax. For companies, it is called minimum alternate tax. We will study that only in your final. So you'll have to wait for a few more years to study that in detail. For time being, we are only going to discuss about a concept of alternate minimum tax, which is applicable for persons other than companies. So that's what we are going to discuss. And it is applicable only for persons who have a deduction under section 10AA, 30, these sections. So 10AA, 35AD, and your chapter 6A heading C. If you have an income under these, if you have a deduction under these, only then this provision is applicable. And your income, your adjusted total income should be more than 20 lakhs. Only then this is applicable. So if it is less than or equal to, if it does not exceed 20 lakhs, this provision is not applicable. This alternate minimum tax is not applicable if your total income, your adjusted total income itself is less than 20 lakhs. What is adjusted total income? Just 3-4 bullet points below, we will have the explanation. So let me go on order. So basically, this alternate minimum tax is not applicable for persons under 115 BAC. So 115 BAC specifically cannot claim this alternate minimum tax concept. So for 11 assessee with who have chosen 115 BAC, they cannot opt for this concessional rate. So they need not compute this alternate minimum tax. And what is this alternate minimum tax? We said even if you have zero tax, you need to pay some tax. So that tax will be 18.5%. So under your regular provision, you'll have zero tax, but under your alternate minimum tax, you'll have 18.5%. How, why, and all we'll just discuss in the below. So how do you compute what is called as the alternate minimum tax, the adjusted total income? So you're going to compute your adjusted total income. How do you compute? You take your total income, whatever deduction you have claimed under section 10A, 35 AD, you add all these things. So which means you compute total income before giving these deductions, before giving deduction under section 10A, before giving exemption under section 10A, before claiming allowance under section 35 AD, before claiming deduction under section this heading C of chapter 6A. Before claiming these, what would have been your total income? Of course, if you remove all these deductions, then you will have a total income. So that total income is called as adjusted total income. On that adjusted total income, you will have to pay a tax of 18.5%. So 18.5% will be applicable for that alternate minimum tax. So that's what alternate minimum tax is about. So you compute adjusted total income, which is nothing but my total income plus disallow all the deductions. I have removed 10A deduction, remove 35 AD, remove heading C deductions, remove all these, backward and compute your total income before giving impact to all these things. That income is called adjusted total income. Of course, after deduction, your income will be zero tax. Now you'll have some income. Let's say it's 10 lakhs. On this 10 lakhs, you'll have to pay 18.5%. So this income, that is, let's say 1,85,000, will be your tax liability. Now, I have paid now, though I don't have tax. Actually, I don't have tax this year, but I have paid tax because of this provision of alternate minimum tax. So government says, whatever you have paid under alternate minimum tax is your tax credit. It's like your TDS, it's like your advance tax. So this tax amount, whatever you have paid now, whatever you have paid in this year, in subsequent year, when you're actually paying income under regular provision, when you're actually paying income under regular provision, you can adjust up to this 1.85 lakhs in that particular year, right? So I'll just do a small understanding. So I have an, let's say, I have a business under section 35 AD. My business income is 40 lakhs. Now, less 35 AD, my expenditure, my eligibility under 35 AD is, let's say, 30 lakhs. So my actual business profit is 10 lakhs, right? Profit or taxable profit. My taxable profit is 10 lakhs. I will pay tax on this 10 lakhs. How much will I pay? Let's say I follow through. Only the regular portion comes under alternate minimum tax. I will just take as 60 and 30 because it is not applicable for persons with less than 20 lakhs. So on this 30 lakhs, I pay tax. So how much will I pay? It is 112,500 for the first 10 lakhs. Plus on 20 lakhs, I pay 6 lakhs. That is 30%. So my actual tax is 7,12,500. Now what happens is, I have to calculate adjusted total income. So my adjusted total income, ATI, is nothing but profit. That is my taxable profit. That is 30 lakhs plus 35 AD deduction. So I'm removing back. So how much deductions I have claimed? I have claimed 30 lakhs. Right? So now I go back to my old income, 60 lakhs. So on this 60 lakhs, flat 18.5%. So one of you can compute that to understand how much is 60 lakhs into 18.5%. So it is 11 lakh 10,000. So my regular tax is 7,12,500. Alternate minimum tax is 11,10,000. So government says pay 11,10,000. Pay 11,10,000 because that should be your minimum tax that you're paying. So you pay 11,10,000, but take credit 11,10,000 minus your income of 7,12,500. So this is 287, 397 if I'm right. So just see whether it is right. So this 3,97,500, this 3,97,500, I will take as credit in subsequent year. In the next year, let's say again I have like around 40 lakhs income. This time I don't have 3580, nothing or whatever. So under 40 lakhs, I will pay my regular rate. Like, so my regular rate will be on 40 lakhs, I'll be computing my regular rate, which will be, let's say 112,500 plus on the 30 lakhs, it is 30 lakhs, I'll have to pay 9 lakhs. So it is 10,12,500. In this 10,12,500, I can take credit, AMT credit, because I've already paid excess in the earlier year. So government says now you take credit of this 397,500. So I'll pay only the balance, that is 612, 615 if I'm right. Just see whether the calculation is right. So this 6,15,000 will become my actual payable in the next year. So this, let's say, is assessment year 21, 22. And this is assessment year 2022, 23. So now I'm taking credit. So this is what is alternate minimum tax is about. So now we'll go back and read that provision again. So this alternate minimum tax, as we said, it is applicable for persons who are claiming deductions under section 10AA, 35AD or any other heading C deductions. So basically, I pay lower tax or zero tax. So in this case, to give regular consistent tax flow to government, whatever is my income before giving these deductions becomes my adjusted total income. On this adjusted total income, I calculate 18.5% flat rate. There's no slab rate. I calculate 18.5%. On this 18.5%, if this tax is higher than my regular tax, then I'll have to pay this alternate minimum tax. So I'll have to pay alternate minimum tax. Whatever excess paid above my regular tax, I take it as credit. I carry forward in the next subsequent years when I'm actually paying income tax in the regular rate, I can take that as credit. So this carry forward can happen up to 15 assessment year. So to claim this credit, there is no requirement in that year I should have a deduction under 10AA, heading C or 35AD. So there is no such requirement. The only requirement is you must have a credit to offset with your regular income. So that is it. So your income level or your 10AA or 35AD deduction in the year of taking credit, in the year of adjusting credit is not relevant. So typically the point is in this year, I need not have 10AA, I need not have 35AD, I need not have heading C. Heading C, I need not have income, adjusted total income, limit of 20 lakhs. So this is also not required. So there is no other condition to adjust your alternate minimum credit with your regular tax rate. So this is about your alternate minimum tax. And this provision is not applicable if you're actually following your optional rate of 115 BAC. So that is what about your provision. Okay, so these are the provisions that we are discussing it right now with respect to your computation of total income. So I'll answer a couple of questions and then we'll move on to problem solving. So there is a separate workbook which is there for problem solving. We'll move on to that. So I'll answer some questions. So some of you have asked about whether senior, super senior citizen is available for basic exemption limit. It is a concessional rate, so there is no senior citizen, very senior citizen. So it is a flat rate applicable. So there you don't have this concept of senior and very senior citizen. And can we carry forward tax credit when AMT is not applicable in the next year? You can carry forward, you can take credit. So carrying forward and taking credit, nothing else is a condition. So there is no additional condition to carry forward and set off. Only in the year in which you are paying alternate minimum tax, there are conditions. For applicability of alternate minimum tax, there are conditions like your income, adjusted total income should be more than 20 lakhs. All this there. Otherwise, to carry forward and adjust your credit, there is no condition. You need not have your income level is irrelevant. Your deduction level is irrelevant. So nothing is relevant with respect to there. It can be there or need not be there. So there is no restriction as to when you can take credit. Credit is available at all times. For the next 15 years, you can carry forward. Let's say for the next 3 years, I'm continuously paying alternate minimum tax. All these 3 years, I'm eligible for credit for 15 years. So in the 4th year, I'll take first year credit. So this credit goes on this chronological order, like your FIFO method in inventory. The first available credit will be adjusted first, and then moving on, you'll take credit for the other years. And you can carry forward up to 15 years. With respect to AMT, it's a flat rate, 18.5%. So there is no concessional rate or flat rate at all. But if you have already opted for concessional rate, then the concept of alternate minimum tax is not at all there. So once you have decided to choose optional rate, there is no concept of choosing this alternate minimum tax. So this is about your thing. So I'll just briefly again describe. I'll just briefly describe this alternate minimum tax once again before we move on to the next. We'll start solving the exercise problems. So this alternate minimum tax is applicable when your adjusted total income is more than 20 lakhs and you have deductions under section 10AA, 35AD or deduction under section heading C. If you have these deductions or exemption, only then your alternate minimum tax is applicable. So it is applicable for assessee other than companies. So it is typically for individual, firm, LLP, all of them. So it is other than companies. Here, there is a flat rate of 18.5% on this adjusted total income. So what is adjusted total income? Adjusted total income is total income before giving deduction, before giving exemption under section 10AA, before claiming allowance under section 35AD, before claiming deduction under chapter 6A heading C. So that is your profit linked and investment linked. So as far as your exam goes, your intermediate exam goes, there are only 3 sections that are covered in your heading C. We have already discussed this here, only 3 sections. Any other section is not relevant. So the 3 section is, we said 80JJAA, which is your employee cost, 80QQB and 80RRB, which is related to royalty patent on author and other royalties. So only these provisions are covered under heading C. So in your question, if there are deductions under these sections, 80JJAA, 80QQB, 80RRB, or 35AD, or section 10AA, then the provision of alternate minimum tax is applicable if your total income is more than 20 lakhs. So these are the provisions that we need to discuss. How do you compute 18.5%? You compute regular income tax. If alternate minimum tax is higher, if this 18.5% is higher, then you pay this. The difference between your alternate minimum tax and regular tax can be carried forward as a credit for a period of 15 years. And this carry forward and adjusting will happen irrespective of whether you have deduction, exemption under that year, or your income is more than 20 lakhs or less than 20 lakhs. So nothing of this is relevant. Whatever your situation is, you can claim this credit in the subsequent year. So this is about your alternate minimum tax and every other provisions like your advance tax, delayed payment interest, late payment, interest due to late payment of advance tax, interest due to late filing of return, all this 234A, B, and C, all these 3 levy of interest and fee will be applicable even in case of alternate minimum tax. So that's all about alternate minimum tax. So that's about alternate minimum tax. So in simple terms, understand, you compute alternate minimum tax and regular tax. You pay to government whichever is higher. The difference, the excess payment above your regular tax, you claim as credit, adjust it over 15 years. So these are the provisions of alternate minimum tax. We will take a small break for 10 minutes. Post to the break. After the break, we will start solving exercise problem for your computation. So to get practice to your examination, we'll start solving. So we'll take a small 10-minute break. problem solving. So as we said, we will move on to the problem solving exercise. So how you will have to basically prepare for your examination. So this is what we'll be discussing right now with respect to next 1 hour or so. So we'll start with the first exercise problem. Most of them are always from your institute material. So in the next session, we'll continue with the other problems. So we'll start with the first problem. So there is a person, Miss Charlie, who is an American national. So she has got married to a person from India. So she has got married in US only. So on 2nd March 2020, she has come to India for the first time on 16th March 2020. So that's the first ever time she comes here. She has left USA. That is, she returns back to USA on 19th September 2020. So she has been here in India for this in-between period. She has returned to India again. She has come back on 27th March 2021. While in India, during that period, whenever she was in India, she has purchased a showroom, which is a commercial property, and she has let out for a company for 25,000 per month from 1st May 2020. So she has let out for the rest of the period. She had taken loan from a bank for purchase of this showroom, for which bank has charged her 97,500 as an interest in that particular year. So these are the information she has given. There is some additional information with respect to gift that she has received. So from parents of husband, so she has received a gift from married sister of husband, and then from she had also received from a friends, various friends. So with respect to 1.72 lakhs she has received from her friends of her husband. So now the question requests us to determine two things. That is, one is related to compute the income. So basically, we need to determine the residential status and compute the total income. We need to see whether something undergoes changes if her income is 18 lakhs. So these are the two things, A and B. So whatever is required here is basically two things, 18 lakh. First, determine the residential status and compute total income, and then see if changes if her income from her foreign income, total income from Indian sources 18 lakhs, for which she has not been liable to tax in USA. So these are the two things that we are going to discuss. So we'll start with the problem. So first thing, as we said, we need to determine the residential status, right? So residential status. So residential status is the first thing. So in this residential status, we are going to discuss about the period of stay. So our first period of stay is between first is on 16th, from 1st April 2020 to 19th September. So we need to say how she computes. So let's say 1st April to 19th September, right? So that is the period of stay as far as she is concerned. So we need to say how many days she has stayed in India. So this stay in India is typically, let's say April 30, May 31, June 30, July 31, August 31, and September 19. So 61, 91, 122, 153, 172. So she has stayed, the first stay, she has stayed for 172 days. So we'll leave this. This is not required. And then after which she again comes back on 27th March. So with respect to this residential status, we need to understand that both the days, that is being in India, both the days being in India is relevant as to be considered as staying in India, both the arrival date and departure date. So that's why we have considered the entire period of including we have also included 1st April, we have also included 19th September. And then the next period is 27th March to 31st March. We are only calculating for this year, of course. So 27 to 31st March is 5 days. So we need to compute 5 days. So the total is 177 days. Now the two basic conditions is, one is, first condition is 182 days or more, 182 days or more in the previous year. The second basic condition is 60 days or more in the previous year, 365 days or more in the 4 immediately preceding previous year. So these are the conditions. Now, as she satisfied the first basic condition, that is, as she stayed in India for 182 days or more, no. So 177 is, of course, less than 182. So she has not satisfied the first basic condition. So now, what is the second basic condition? We need to see whether 60 days or more in the previous year. Yes, she has stayed in 60 days or more in the previous year. Then four immediately preceding previous year. So when you say immediately preceding previous year, this question is talking about financial year 2021, right? That is previous year 2021. So for immediately preceding previous year. So we'll have to compute previous year 2019, 2020, 2018, 2019, 2017, 2018, 2016, 2017. How many days has she been staying in this particular period? Now, here is where we need to give importance to this word of first time in India. So it says about first time in India. So this first time in India means that she is only coming here for the first time. So we'll have to only consider the 16th March. She is coming here on 16th March. So 16th March to 31st March is the period of stay in India. So which is nothing but 16 days, right? So this is 16, this is 0, 0, 0. So your total in the four immediately preceding previous year is 16 days. So she has not satisfied the second basic condition also. So once she has not satisfied the second basic condition, the status become non-resident. So here you have some exceptions, right? In this case, instead of 182, the 60 days in the second basic condition, we use the word 60 days or more and 365 days or more in the four immediately preceding previous year. But we have an alternate condition where if you are an Indian citizen or a person of Indian origin, you're leaving India for employment, you're coming into India for business profession or something, or if you're leaving outside India in a crew member as in an Indian ship. So all these cases, there are some exceptions, right? The reason why I'm just rushing through this is these are related to residential status. You would have already covered. So I'm just only recapping. So if you are falling under these exceptions, the person of Indian origin, citizen of India, leaving for employment, or a crew member of an Indian ship, or a person of Indian origin or Indian citizen coming into India for business, profession, or vocation. For these people, the second condition, that is, there is no 60 at all, it is always 182 days. So in short, they will be considered as a resident only if they have stayed in India for 182 days or more in the current previous year itself, in the previous year itself. So that is the point with respect to some of the exceptions. Here, she is not a person of Indian origin or citizen of India. She is only married to an Indian citizen. So in this case, we will continue to hold on to the two provisions, that is 182 days or more in the previous year, 60 days or more in the previous year, and 365 days or more in the immediately preceding previous year. In both these conditions, she is not satisfied. So she continues to be a non-resident. Now, being a non-resident, what happens? What all income is taxable? Basically, when you say a non-resident, an income received in India or accrued in India alone is taxable. So it is either deemed to receive or deemed to accrue or arise in India, only these conditions. So in short, rather than using a technical word of accrue, arise, receive, and all these things, in short, there must be a connection in India. In some way or other, that income must be situated in India. Either the property must be situated in India or the source should be situated in India. So in some way or other, there must be a connection in India. Only then an income becomes taxable in India. So here, we are talking about several heads. So the second step is classifying each head of income, right? Here she has two heads of income. She has income from house property. She has income from other sources. These are the two heads. So we'll first compute income from house property. So I'll have particulars. So I'll have particulars. I'll have amount. I can have a note section here, or I can continue to hold on to. This particulars amount, another amount column. So wherever note is there, I can have an extra column. We have already discussed this. It is always better to have a note column separately somewhere like this. Write the note below. So it's always recommended that you write as much as notes as possible to make sure you are clearing, you are explaining the valuer that you know things. You have understood and solving. You are not just like that solving. You have understood and solving. So that is what is very important here. So the first head is income from house property. So income from house property. So we compute how much is, so basically house property you would have seen, you must have a municipal rent, you must have a fair value, you must have a standard rent. Only then you'll be able to compute gross annual value. But if your exam question does not provide these, whatever is provided as the rent, that is your actual rent received, shall automatically be considered as your gross annual value. So you need not do any valuation with respect to municipal value, subject to standard rent. All these calculations need not be done. You can straight away take whatever is provided in the question. So what is the rent provided in the question? It is 25,000 per month from 1st May 2020. So for 11 months. So rent is 11 into 25,000. So you'll have to write it in the note. In note 1, you'll have to state that as detail of municipal value, fair value, standard rent has not been provided, actual rent received has been considered as gross annual value. So this is the thing that we need to specify with respect to your note. So my intimation here will be how much? 2.5, 2,75,000. So in this 2,75,000, I next compute less, right? So you need to reduce. So you need to reduce your standard deduction. You have a standard deduction in the section 24. So I'll just write it as ST at 30%. So on 2,75,000, you are eligible for 30%. So how much of 2,75,000? You are eligible for 82,500. So the balance will be 1,92,500. So that's the balance. So this 1,92,500 will be actually considered as your net total income. On this, you will also have to deduct. I'll just put this later. So you also have to deduct interest. So whether interest from other people, that is your basically any interest that you're paying towards this loan can be allowed as an expenditure. So this can be claimed as a deduction. So this interest payment of 97,500. So the 97,500, whatever has been given as your interest is eligible. So I claim 97,500. So my total income is 2,75,000 minus 82,500 minus 97,500. Right? So 95,000. So my income from house property is 95,000. So on this 95,000, whatever is my income from house property, I have calculated now. We'll have to move on to income from other sources now. So this income from other sources. So this income from other sources, whatever we are discussing, we'll have to calculate as far as each of the income that we are concerned. So we'll have to go through, remember the portions of income from other sources. In income from other sources, we said gift from relatives, there is no restriction, there is no amount restriction, nothing. So whatever is received as relative is taxable. In relative, we discussed about basically a spouse, parents, brothers, sisters, spouse of brothers, sisters, all of them are covered under your relative definition. So here, parents of husband. So basically, parents of husband are relative. So this 51,000 is not covered. Similarly, married sister of husband, brother, sister of husband is a relative. So basically, that 11,000 is also a thing. So what we have to do is we'll have to write income from other sources. The first one is gift from in-laws, right? So note 2, you'll have to state that they will fall under the definition of relative, hence it's not taxable. So you write nil. Next, gift from husband, sister. Note 3, again write, you can even write it as a common note. Both of them can be 2 and say that being a relative, sister's husband and gift from in-laws is not taxable because they are classified as relative under section 56. So this is nil. The third one which we are talking about is friends. Friends of husband. So they are not a relative. So on this, typically we'll have to see how much they have received as gift. They received 1,72,000. So this 1,72,000 is totally taxable, right? 1,72,000 is totally taxable. So this 1,72,000 is income from other sources. So we have income from other sources. We have income from house property. Both this put together, you have gross total income. So next, is there clubbing? No. Is there any set off carry forward? No. So you directly move on to the gross total income. As far as gross total income is concerned, 2,67,000 if I'm right. So 2,60,000 is your gross total income. We need to see, is there any other ATC deduction or something of that kind? No, nothing has been specified related to ATC of that kind. So we can straight away take this 2,60,000 as your net total income also. So this is also your net total income. So this can become your net total income. That is your 2,67,000 is your net total income. On this net total income, on this net total income, now you start calculating your taxes, right? So for calculating of taxes, we need to know her age so that we understand whether she's a senior citizen or not. They have not given anything about the age. So if they have not specified about the age, automatically they become a normal citizen. You cannot assume someone to be a senior citizen or a very senior citizen. So typically you have to assume them to be a normal citizen. So this citizen, this normal assessee, regular assessee, so they are not a senior citizen. For this regular assessee, now we'll have to compute the tax. So for the first 2.5 lakhs, so income tax. Income tax on this 2,60,000 up to 2.5 lakhs is exempt. On the 67,000, we claim 5%. So that will be how much? 3,350 if I'm right. So now you are eligible for rebate under section 87A because the total income itself is less than 5 lakhs. But moment we see this income of 5 lakhs, we should not get carried away and straight away say that rebate has to be carried out. The critical point here is we have been talking her about as, we'll just write rebate under section 87A. I'll again add a note column here. I'll specify 3. Whether rebate under 87A is eligible for her or not? No, not eligible. Reason, very simple reason. She is a resident. She is not a resident. So moment she is not a resident, she is not eligible to claim the rebate. So this will be nil. So now 3,350, there is no surcharge. So you add cess, that is at 4%. So here cess is a straightforward portion, it is 4%. So on this 3,350, you apply 4%. So that is 134. So the total will be 3,484. So she has to pay 3,484 of tax liability. So this tax liability, whatever she has to make, this 3,484 is spending. The second question is request you to understand if a residential status will undergo any change, assuming that she is a person of Indian origin and a total income from Indian sources is 18 lakhs. And she is not liable to tax in USA. We were talking about the income with respect to residential status. Sometimes what happens is you are a non-resident, you earn income from India, you earn income from Indian origin. So basically, this income, this 18 lakhs income, what happens is you are not taxable in the foreign country. You are only taxable in India on that particular income. So for these persons, what they do is, even though they are the residential status, we have brought in a new concept called deemed resident. We discussed about this. It has been introduced in Finance Act 2020 for individuals. For this deemed residents comes under a picture when they have stayed in India for more than 120 days, but less than 182 days. So in case for people who have stayed more than 120 days will automatically be called as a deemed resident. Here, she has stayed more than 120 days, right? So she has stayed more than 120 days, but again, she has not stayed in India for more than 365 days in the 4 immediately preceding previous year. So she continues to be a non-resident because she has not satisfied the basic condition of 120 days and 365 days in the email. So the first condition is always 182 days. Only the second condition, it is 120 days or more and 365 days or more in the 4 immediately preceding previous year. She is not satisfied that. So automatically she continues to be a non-resident. So nothing undergoes change. So we'll have to explain this provision of deemed resident, write about the characteristics of deemed resident, and say she continues to be a non-resident because she has not satisfied this 365 days or more in the previous year. So the computation continues to remain as 365 days. So that's the question. So any doubt in this thing, I'll just answer. Okay. So that's it, right? So any specific questions? Yeah, so that's the thing, right? So I guess some of you have a question on the tax computation alone. So basically, first to 2.5 lakhs, there is no tax. So we are computing 5% on 17,000 alone. So basically on 17,000 only, we should have computed tax. So it is 17,000 into 5% and not the whole amount. So this will be 850. This will be 850. So I'll just put it here. It is 850. On 850, you compute 4%. So because she is eligible for this basic exemption limit of 34, so it is 884. So basically your income on the 2,67,000, the concept is you ignore the 2,50,000, you compute only on that 17,000. On 17,000, you compute 5%. That is how 850 has come. On 850, you compute 4%. That is 34. You calculate 884. This 884 is what should be considered as your total tax. Being a non-resident, she is not eligible for rebate. So the entire 884 is tax payable. Will it change if she is a deemed resident? That is, if her income is 18 lakhs and she is an Indian origin, will still continue to be a non-resident. So there is no change in the residential status. So even after the B thing, even after considering that, she will still be non-resident in India because she has not satisfied the second limb of basic condition. That is 120 days or more during the previous year and 365 days or more in the 4 immediately preceding previous year. So in this case, she has satisfied 120. So this is 120 is obviously lesser than 177. So she has satisfied, but she has not stayed here more than 365 days. So this she has not satisfied. So she continues to be a non-resident, even in spite of saying that she's an Indian origin who has a foreign Indian source income of 18 lakhs and above. So that's the answer. So it is so I've corrected the thing. It is only on 17,000. So it is basically I've calculated on the whole to 2,67,000. She has a basic exemption limit of 2.5 lakhs. So the tax must be calculated only on 17,000. So you apply 5% on 17,000. That is 850. On 850, you compute 4% on cess, which amounts to 884. So that is why it is there. So whatever should be calculated is only on the income above basic exemption limit. Individual has a slab rate, so we'll have to use that as the question. Okay. So we'll move on to the next question. So next question. So now as far as the next question goes, basically Niranjana is a resident individual age 60 years. So the key words are resident here and a key word is 60 years. So basically she's running a clinic. She is a professional. Her income and expenditure account has been given. Now let's just give a moment and think about how your exam questions will be. What are the heads that will be typically tested? Your primary in overall computation of total income. And your question is about overall computation of total income. This is a typical model that you'll get. This question number 2, which you're going to work now, will be a typical model for your exam, whereby you will be given a P&L account. From P&L account, you compute, you classify income, and then start working out. This will be a typical computation problem as far as your examination goes. So, the importance of this computation to total income is around 15 to 20% of mark. There is around 9 to 12 mark. So you probably will have a one independent question only on computation of total of income. In this computation of total income, a typical model, a common model in examination will be this exact question, whereby you have an income and expenditure statement or a P&L statement and some few information, additional information. Based on that, you compute, you classify, you compute, and calculate tax liability if required. So this is how the general question remains. So in this question, again, if you see, a person is a senior citizen because she is a resident and 60 years. So, and she is a senior citizen. In the table below, you have expenditure, you have income. In this income, you have this consultation of medical charges, which is basically a clinic income. So whatever is a clinic income is given as your income. And then she has income tax refund. In income tax refund, there is two components. One is whatever tax you pay, the tax amount, that is your principal amount, your income tax amount, and interest on income tax. The principal amount is nothing but whatever you have paid, you are getting back. So that is not an income. It is only getting back the excess tax paid. But interest income is an income under income from other sources. So now we'll have to first, as I told you in the earlier classes, we need to first understand the question. We need to consider the relevant words, ignore the irrelevant words. We'll have to keep the keywords and make sure that probably we mark it or give a reference in the question paper itself to make sure that we don't miss information. So that is very important as far as your exam goes. So that is how you need to calculate. So in this case, whatever we are talking about, there has been various income listed here: by income tax, by dividend, and you also have dividend income. Dividend income is also your income from other sources. By winning from game show on TV, if you see the word in bracket, it is net of TDS of 15,000. So what needs to be given importance? You would have already studied TDS chapter. In your TDS chapter, you would have studied about independent tax rates for each of the sections. So for this particular concept, this crossword, lottery puzzles and other thing, the TDS rate itself is 30%. So it's a 30% TDS deducted. So which means after deduction, you are getting 35,000 after deduction. So when you say net of TDS, it is after deduction. When you see the word gross, which is before deduction. So whatever we need to include as an income is before deduction, because deduction part is a tax amount. That is not, should not be reduced from income. So be very clear on this. Wherever you see this word net, you will have to add back the TDS or compute the TDS and add back. So in this case, TDS has been specified as the amount itself. So it has been given as 15,000. So this 35,000 plus 15,000, 50,000 is your income from winnings from this game shows and other things. So that is what is important here. Other additional information here given here is rent paid. So your rent paid includes 30,000. Your rent paid includes 30,000 by way of check towards rent for a residential house in Surat. And then she has purchased some, okay, before getting into this expenditure, we will cover the expense part. So the medicine consumed. So she has consumed medicine, which is related to her business, right? So whatever business she has been doing, it is related to that. Staff salary related to business. Clinic consumables related to business. Rent paid, it could be related to business. Administrative expense. Scientific research. So for scientific research, there is no more weighted deduction. You are eligible for a flat deduction of 100%. So this 1.5 lakhs, you are eligible to claim 1.5 lakhs. So since it is already there in the P&L, it means it has been allowed as an expenditure. So there is nothing else to do about it. So now we have read through the expenditure. After going through this expenditure and income part, come back to this other information, go one by one. The first one is about rent paid, which is 30,000 towards rent. So whatever rent paid, that 90,000 which we are talking about, includes this 90,000. This 90,000 includes this 30,000, which is personal. So is personal expenditure allowed? It is not allowed. So basically we need to ignore this 30,000 from that 90,000 expenditure. Next point is clinic equipment. So whenever you have an adjustment, what I suggest is when you have to make an adjustment, just mark with some reference. Maybe in your question paper, just do a tick mark here. So, which means you need to do an adjustment. So, what adjustment? This is not a business income. This is income from other sources. So, I'll have to remove from this P&L, that is from business income, treat it under income from other sources. Dividend income, I should make an adjustment. I'll have to remove from business income, treat it under income from other sources. This income, I have to do two adjustments. What adjustment? One is, yes, I have to move to income from other sources. Another is, this is net. I'll have to consider gross. So, this two adjustments, I'll have to just give two tick marks. So that I'll remember, I'll have to make two adjustments to this particular clause. Next, I come to rent paid of 30,000, which has to be adjusted to this. I give a tick mark, whatever way you wanted to refer. So typically, I'm just trying to make sure that you don't skip, you don't miss, you know the order in which you need to work upon. So spend time on reading the question. So rent paid includes 30,000, so that we have considered. Clinic equipments or opening WDV. So they've given the opening WDV, they've given what has been acquired during the year. So both, there is no depreciation here in this expenditure. In this expenditure, there is no depreciation provided. So just give a tick here itself. So you need to give addition here. So these two things has to be considered. You need to calculate depreciation with respect to income tax depreciation and work upon it. The next one is related to rent receipts related to property situated, received. Rent receipt relates to property situated in Surat, where the annual value is 27,000. So this rent, right, I need to compute under income from house property. So that is a thing. And then there is this 2,000 paid in December 2020, the municipal tax. Municipal tax is allowed on payment basis. So whatever has been paid during the year is allowed as an expenditure. So municipal tax paid is included in administrative expenses. So I need to remove this from administrative expenses. It is not part of administrative. So I need to make an adjustment there. And I also need to reduce it from here. So there is a two adjustment for rent. So rent, I remove it to income from house property. I reduce municipal tax. So these two things I need to do. She received a salary of 7,500 per month, which is not part of, which is not being included in medical charges. So I no need to do anything there. I only need to include this independently in income from salary. So Dr. Niranjana availed a loan of 5.5 lakhs from bank for higher education of her daughter. She repaid a principal of 1 lakh and interest thereon. So she has repaid a principal of 1 lakh as far as the loan goes. 5.5 lakhs from bank for higher education of her daughter. So we need to see whether it is eligible. And the interest thereon is 55,000. So this is not here. So the interest thereon is 55,000. So this I need to make an adjustment because it is eligible for a deduction. We need to see whether it is eligible for deduction. But moment it is for a daughter, it is eligible for deduction. So and it is for higher education. So whatever loan paid, interest from that is eligible for your deduction under section 80E. So this is what we are going to take it. Now she paid 1 lakh as tuition fee, not in the nature of development fees or donation. So which means it is a tuition fees. It's a clear tuition fees to the university for full-time education of a daughter. So university school full-time is allowed with respect to it, for daughter is allowed. So now this is also eligible for deduction under section 80C as a thing. An amount of 28,000 has been paid on a medical insurance premium. It says check. It does not say whether account pay check, but we can always assume it is an account pay check. We can always assume it is a bank mode. So as far as your 80D is concerned, it is not relevant about whether account pay check or not. It is only relevant that it is not paid by cash. It is only like that. Only in your business or other sources, the provision specifically states it has to be through an electronic mode. That is your NEFT, RTGS, account pay check and all these things. In your 80C or 80D, it only talks about not through cash. So which means other than cash is allowed. So it doesn't matter whether it is an account pay check or not. So this check word is probably to confuse us. It only to say that it is not cash. So we need not see whether it is account pay or not account pay. So these are the things that we are going to work out. These are the things that we have given tick mark and we are going to work out. We are going to work out in the order of problem, right? So we are going to work out in the problem of, in the order of whatever question we are talking about. So the first thing is about salary, right? So 7,500 per month. So we'll go here. So computation. Okay, before that, we also have to understand what exactly we need to do. So we need to compute from the above, compute the total income, Dr. Srimati Niranjana for the assessment year 2021. So we need to compute the total income under the regular provisions of the income to assume that she has not opted to pay tax under section 115 BAC. So I am not going to compute for 115 BAC itself. Straight away, I'm going to compute only regular provisions. Now we can go into the problem. So I'm only going to compute normal income. So computation of total income. So this must be the header of your exam of Miss Niranjana or Dr. Niranjana for assessment year 2021-22. So that's the first thing. So you compute this, then you start with particulars. As I told you, I have an two amount columns and then a reference column. So this reference column will help you in helping you indicate the notes related matter. Right? So these are the things. So the first thing is we said it must be income from salary. So I will take here also. Okay, so first one is typical exam problem. So please make sure that you go through in specific, in detail. So this income from salary, we have discussed about what she has received. So she has received salary, right? It doesn't talk about DA, perquisite. So that's the point of computation of income. So you will have separate problems of salary where you will have specifics in specific about your allowance, perquisite, and all those things. But when you talk about the chapter computation of total income, you will not have much to do under individual head, but you'll have something else to do on the overall aspect. So that's the difference. And you're going to get straight away 12 marks if you know this flow of solving the problem. So 12 marks is in your hand straight away. So the question is about salary, 7,500 per month from full career, and it's not been included. So since it is not included in my consultation fee, I need not remove it there. I'm only going to do it here. So now income from salary is 7,500 into 12, right? So 7,500 into 12 is 84 plus 6, 90,000. So it is 90,000 less. Moment you call salary, what you should do? Less standard deduction under section 16. How much? 50,000. So income from salary is 40,000, right? So next head of income will be income from house property. So the next head, go in the order of your classification. Don't skip order. Don't write first business or profession, first other sources. Don't do that. There is always an order. Whatever head of income you have studied in that order, only in that order you need to compute. If you have a problem in computing here, you can always go down and do it as an annexure and then bring it here. You can write even income from salary, note 1, compute below. Income from house property, note 2, compute below. You are always free to do that. Just depending upon the volume of adjustments that you need to make, decide whether to do it straight away in the computation or do it as an annexure. So that's what is important here. So here we are going with the straight flow just for the sake of understanding. So income from house property, I'll have to calculate the rental income. So this rental income. So now I can, since I've done this, now I'll just close this. I've done this. So I'm classifying this, that I've completed this particular point. So I'm not going to go back into this. The next point is about house property. It is about rent received, right? So here is what we are going to discuss about rent received. Here we have given 2 ticks. So we are going to do 2 things. One we'll do in house property, another we'll do in business or profession. So right now we'll do it in house property alone. So we are having a rental income. Nothing else is given, fair value, municipal rental. So whatever is given the rental will be considered. So gross annual value itself is 20,000. So I take gross annual value, that is your 27,000, right? So there is no, there is 2000 municipal tax paid, right? So this 2000 has to be adjusted here, reduced here. So less municipal tax of 2000. So 25,000. So this 25,000 is becomes your net annual value. Use the terms in examination so that you prove, you explain your valuer that you know. I'm stressing this point several times repeatedly because that is the key for your examination. You need to show, you need to prove, you need to make the valuer believe, you need to make him believe that you have understood and solved the problem. You have understood and solved the problem. It is very critical for examination. It is not about solving, it is about telling the valuer that you have understood the problem, you have solved. So that is as simple as it is. So please make sure you clearly give the notes, you clearly specify your understanding here and there. So that's what is important. So now in this NAV, I'm considering 25,000 and then less standard deduction under section 24. So which is 30%, right? At 30%. So it is 7,500. So this 7,500 is 30% of 25,000. So I take, so I'm just continuing the problem. So this 25,000, 17,500, I get what? 17,500. So that is your what? Income from house property. Okay, so now I've got this income from house property. Next, in this case, I've done one tick alone. So I've removed it from, I've considered an income from house property, but I've still not removed it from business or profession. So I have two ticks there. I've only done one. I've not done the second one. So I'm retaining the another tick. Okay, now we'll move on to the next chapter, the next head of income. Next head of income is always business or profession. So the third is income from business or profession. So let's assume income from profession. She has a clinic business. So that is your income from profession. So we'll have to straight away take the net profit. So we take the net profit. How much is the net profit? 4,40,400. 4,40,400. So this 4,40,400, we need to adjust all the heads of income. So in adjustment, there are 4 types of adjustment in your business or profession. Whatever you have studied, you would have studied. I'll just summarize this 4 heads alone. The first head is, let's keep it this way, 2 heads related to income, 2 adjustment related to income, 2 adjustment related to expenditure. So I'll just write it somewhere and then delete it. So with respect to business adjustment, there could be an adjustment related to income. There could be an adjustment related to expense. Both this income and expenses, there are 2 adjustments each. One is already in P&L, not in P&L. Same way, P&L, not in P&L, right? So these are the things that you need to give adjustment. So income considered in P&L, what should you do? Income not considered in P&L, what should you do? Expense in P&L, what should you do? Expense not in P&L, it's not at all booked, what should you do? So these are the things that you need to consider. And broadly, when you're computing the problem, what you will do is, you will do it as categories. So the first category will be income treated separately. Income treated separately. So basically, this income is not classified under business or profession, so it has to be treated separately. So this is the first adjustment. The second adjustment is related to reducing, right? You're reducing. So these are less. So you need to less 2 things, add 2 things. Next is, when you're treating income, considering separately, you're reducing the profit. Next is allowable expenditure. Allowable expenditure is nothing but It is an expenditure, but it is already not there in P&L. I'm just allowing it now in my Excel. So this will come under this category. So it is an allowable expenditure, which is not in P&L. I'm allowing now. So these are the two things that I'll reduce. Now coming to third thing. So the third thing will be adding. That is third and fourth is adding. Okay. Third thing is income considered now. Income consider. So this is basically an income not in P&L. So you're going to treat it as an income now. So this income you need to add. Fourth is disallowed expenditure. So an expenditure not allowed. Yes, it is in P&L, but it is not allowed. So I'm disallowing. So now these are the four things that will make in every question. Every question you'll do these four things. If you want, you can even do this in problem by saying that you need to do a minus here, you need to do a plus here. You can even do this. So you know that you're going to minus something, you're going to plus something from this. So this will give you a more clear picture. So for example, in rent, we said 90,000, 30,000 is a personal rental. So which must be added as an expenditure, which is not an allowed expenditure. So you're going to add, right? So you can even do this. Instead of tick, you can do add. Sorry. So basically, in this question paper, just give a small mark to say whether you're going to add or whether you're going to deduct, or you can even say whether you're going to make an adjustment. It is up to you. It is freely up to you, but make sure that you're doing it so that you know what to do, when to do. So this is very critical for scoring marks in your examination. So please make a note of it. As to you read the question and start marking what to add and what to less, what to adjust. So these markings is important for your examination. So now we'll go on to this business or profession. So that is where we said there are four. I'm going to remove this page completely. Like we have already studied this. So let's assume that we are not going to, we'll cover this in the independent problem itself. So as I told you, there are four things, right? So the fourth thing is you less two things. One is income considered separately, allowable expenditure. So that is the two things. And you add two things. What do you add? Income considered now. That is income considered now. Second is expenditure disallowed. So these are the two. So two less, two add. Very simple, right? So there is no, it's no Greek and Latin. It is straightforward. You're going to reduce two things. You're going to add two things. Under these said, you categorize. So now we are going to categorize. What is the first thing we need to do? Income considered separately. So less income considered separately. So I'm going to list down the income that has to be considered separately. So the first income which we are talking about, we have to go through our P&L and just see what we are doing. So the first thing is income tax refund, right? So this income tax refund is not an income to be considered here. And out of this income tax refund, 5,000 is not at all an income because it is just adjustment to the tax that you paid. So it is not at all income. 450 is an income, but treated under income from other sources. So my first thing is income tax refund. So I am going to remove 5,450. Why? 5,000 is not at all an income. 450 rupees is going to be considered the income from other sources. The next one. Next. So now I have done this, right? So I'm going to cut this. I still have to have another mark here because one I need to remove, another I need to do it under income from other sources. So I have another add mark there. So because one to remove from business, one to treat it under income from the sources. Now I have removed from business, so I have crossed that, but I've still not added to income from other sources. So I have another tick open. Dividend from gross. This also I have to have two ticks, right? To make it very clear, I'm just adding a two tick for your benefit. So the first tick to remove from business, second tick to include in income from other sources. So this next is dividend income. Dividend income is gross. You can straight away take it. How much is it? 10,500. So again, I go back here. I cut one because I've added. I keep one. My winnings from game shows on TV net of TDS. We said two things here. One is to make sure that you are going to remove from business. Another is to include in income from other sources. But when you're including, you need to consider this net of TDS word. So the first thing I'll remove from here, that is winning from game show. Sorry. So it is 35,000. Here I need to specify 35,000 because the impact in P&L is only 35,000. Right? So now my total year is after 444. I'm adjust these things. Oh, sorry. We have already considered rent under a house property. We are going to consider. So we have already considered rent once. We have one more tick in rent, which is to just ignore it from, your, which is to ignore it from business income. So I'm going to ignore this 27,000. I'm going to ignore this 27,000 from this question. So these are the things that I'm going to ignore. Now I need to compute how much is the next income. So I'm going to add. So I'll use a calculator. 440, 400. Sorry, 440, 400 plus 5,000 minus 5450 minus 10,500 minus 35,000 minus 27,000. So it's left with 362, 450. Right? Now the next less is allowable expenditure. So I do a next less, which is allowable expenditure, right? So this allowable expenditure, we need to see what are there. So now allowable expenditure will always be only in the other information. It will not be there above. It will always be in other information. So in other information, one of the allowed information is this depreciation. There are two depreciation here. So we need to compute depreciation. This clinic equipment, whatever is given, is basically a plant and machinery because that is useful for the business itself. So this plant and machinery is generally taxable at 15%. So now the question comes, should I remember the depreciation rate or not? Yes, you have to remember the broad rates for sure. That is definitely yes. At least a broad classification, you need to remember how much for vehicles, how much for plant and machinery, how much building, all that has to be, you need to remember. But in most cases, your exam question will specify the depreciation rate by itself. So that's how it generally works. But to have a better grip on it, it is always good that you remember the depreciation rate specifically for the broader categories. So that is important as far as the question exam goes. Okay. So now we'll move on to this question, back to this question. Depreciation is given, rate is not given, but we know it is plant and machinery. It falls under 15%. So now first is opening WDV. So I give depreciation, let's say opening. The depreciation opening is basically 5 lakhs into 15%. So 5 lakhs into 15% is 75,000. Depreciation addition. Now the P&L does not have depreciation. Otherwise, what should I do is I will reduce this, but I'll add the depreciation. So that is important there. But here the depreciation is not being given in the exercise itself. So I'm only giving income tax depreciation. So this depreciation addition, whatever is being computed is for the new addition. So what is the new addition made? New addition is made on 7th December 2020. So when you say 7th December 2020, we need to see the moment you say new addition, you need to understand whether it is less than 180 days or more than 180 days. Maybe you can broadly keep a cutoff of 30th September or something. So anything above 30th September is, of course, less than 180 days. So this 180 days, if less than 180 days, you can claim only 50% of depreciation. So this 50% of depreciation on 2 lakhs, you calculate divided by 2, that is 7.5%, right? So this 2 lakhs, you calculate 7.5%. So 2 lakhs, 7.5% is 15,000, right? So this 15,000 you take into consideration. is any additional depreciation there or nothing of there? No, because additional depreciation is allowed only for manufacturing companies. It's not for everyone else. So now there is no additional depreciation. Is there anything that I need to do? So now I've taken this, I need to take this. Is there any other thing that I need to consider separately? Disallow. There's nothing else I need to allow. Additionally allow, there is nothing else. Other things are only related to disallow. And this is where the minus and plus helps. So when you give a word minus plus, you know I've completed all plus. You know I've completed all the minus. So instead of tick, you can even keep this minus and plus for you to help. Maybe in the next problem, we'll use this minus and plus so that while just following, you will know which is better, which is comfortable for you. If you think that minus and plus is going to help you, you can follow that as an exam strategy. Otherwise, you can continue with the tick. Okay. Now moving on, we have covered this allowable expenditure. So now again, recompute here. You reduce and recompute and see how much you need to do. So I need to do 360, 450, 362, 450 minus 90,000. So that is 272, 450. Okay. In this 272, 450, now I need to go and understand what should I disallow. So we said two things to add. Is there any income that you need to additionally consider? Is there any expenditure that you need to disallow? These two things we need to consider. We don't have any income which has to be additionally considered in this. In this, we don't have any income. Yeah, this is related to deduction only. In this area, we don't have anything that is related to claiming any additional income. There is nothing of that kind. So we move on to this concept of disallowing expenditure. So add expenditure disallowed. So expenditure disallowed. So this is what we are saying. Expenditure is disallowed is basically an expenditure not allowed in your computation of income. So we'll go one by one. Okay. So we'll start one by one. We have tick marks, right? So we know what to actually work on. Go to your expenditure column. So start here. So this is where you need to go. So is there any tick here? There is a tick in rent paid. So now come to your other information, see what is relevant. What it says, rent paid includes 30,000 paid by check towards rent for a house in Surat. So this is personal rental, which is not an allowed expenditure. Section 37 in business says any personal expenditure is not an allowed expenditure for business purposes. So my first thing, personal expense. So I basically add rent personal. How much is it? 30,000. Okay, so now I have computed this, done. Administrative expenses, I have given a tick. Come back here. So this is also done. This is done. Administrative expenses. Here is the word administrative expense. 2,000 of municipal tax has been included. 2,000 of municipal tax has been included in your expenses. That is your administrative expenses as 2,000 of municipal. So you add municipal tax, administrative expenses. How much? 2,000. Okay, we are done with that also. So this is done. There is no tick here. There is no tick here. But we'll have to see, is there something else required? One more thing, probably what you can do here is in this what we have considered so far, scientific research. We have to specify something, right? What has to be done? When you ask me what has to be done, nothing has to be done because it is already allowed in your P&L and it is only eligible for 100%. So moment it is eligible for 100%, you have already claimed 100%. Earlier, scientific research had provisions whereby you said you spend 100, you are eligible for 125. So which means apart from 100, you also take another 125. So you, like your depreciation, you first add back to your profit and then reduce it from your profit again. So similarly, you do that. But nowadays, it's all 100% only. So this scientific research, 100% is already claimed as an expenditure. So I need not go back and again do an exercise to again claim it. So what typically we have to do is we have to state the scientific research somewhere. So scientific research is an allowable expenditure, right? So probably like places like here, I give scientific research, give a note and say nil. So in note 1, I'll be able to explain that this pertains to scientific research expenditure, whereby an assessee is eligible for 100% deduction on that expenditure. Considering that it has already been claimed in your profit and loss account, no adjustment is required. So this can be a note which explains very clearly that this is an allowed expenditure, and what is allowed is 100%. Since it's already allowed in your P&L account, I'm not giving it again. So this could be a very clear explanation to say that further adjustment is not required. So that is what that explains. So is there anything else that we are leaving out? So yeah. So this typically is only a note thing. Next is net profit. And we have covered this 27,2,000. We have covered salary. We have covered loan. Okay, that is all in deductions. So as far as income, I guess that's all. Okay. So now you compute your business income. So as far as your business income goes, 272,450 plus 32, right? So 3 lakh 4,450. So 3 lakh 4,450 is what you take. So this becomes your PGBP. So next you start with income from other sources. I'll just finish this problem and then we have a couple of more problems. Anyways, it's an institute material problem. I'll upload it in the portal. But my suggestion is try to work it on your own without seeing the solution. So when you see the solution, you get driven away. So try to solve it on one. Obviously, we'll discuss about that solution in the next class also. So this income from other sources, we'll have to come back. We'll have to include this income from interest, income tax refund, interest on IT refund, 450. We should not include that 5,000. It's only 450. Next, dividend is gross. So I put an into here also. It is 10,500. Dividend, please note, it is only taxable from this year. So we already discussed if it is a dividend received in financial year 2021, previous year 2021, but announced, declared in financial year 2019-20, then in that case, it's not taxable because whatever has been announced in financial year 19-20 would have been subject to dividend distribution tax. Hence, it is not taxable in the hands of the assessee. But if it is not clear, the question is not specific about something like this question. It only says by dividend from UTI gross. It doesn't talk about the date, anything of that. So you take it as taxable. So that's what you have to do. So, but if it has been announced, declared in previous year 1920, received in 20, not taxable. It is not because till last year, the dividend that is subject to dividend distribution tax is not taxable till 10 lakhs. Only above 10 lakhs, it becomes taxable. So someone earning a dividend income above 10 lakhs and all is one of the rarest of cases. So unless someone wants to test you, it's okay. But otherwise, dividend income declared in previous year 1920, received in 2021 is not taxable in 2021. So just remember that alone. Otherwise, it's fine. So next, after dividend, you have you have winning from gross. You have two things winning from gross here. One is to basically include in income from other sources. So lottery, how much should be put? 50,000 because it is what was reported as net of TDS. So you take the entire amount. So you take this entire amount. So you have reported, rent is reported. Everything else, this 5, 6, and this clause is all related to deduction. So that's all from income from other sources. So it is 64,500. So your gross total income. Your gross total income. Your gross total income is 40, 57, 500, 61, 950, 361, 950, 362, 450, 366, 422, 450. Just check the total ones. 40,000, plus 17,500 plus 304,450 plus 64,500. Okay, it is 422,900. Okay, so it is 422,900. So that's the total. So that is your gross total income. So your gross total income is 422,900. Now we are coming to chapter 6A. Next class, we'll also talk about how do you know how much space you need, how exactly you need to space, and also that also we'll discuss. So we'll move on to chapter 6A. So for chapter 6A, the first thing is loan for daughter 80E. So 80E interest is allowed. Whatever interest you are paying is allowed as a deduction. But let's just hold on here for a moment. When you're solving this chapter 6A deduction, you have to do in the order of sections. So your first preference has to be 80C, then you go to CCD, then you go to DD and all those things. So here, whether we have something related to C, we have this tuition fees. So this is 80C. So this also maybe you can write it in your question. So that is 80C tuition fees. So tuition fees is allowed, only the development and other things is not allowed. So 1 lakh is allowed. Maybe you can write a note saying that full-time education fees is allowed. So you can even say that more the notes, better for you. But make sure you're writing it very clearly. Next is you have medical insurance. Medical insurance is 28,000. Generally for self, 25,000 is allowed. But if you're a senior citizen, then it is 50,000. So what is her age? Her age is 60 years. So she's a senior citizen. So the entire 28,000 can be claimed. Right? Then you have 80E interest. In this interest also on education loan. In this thing also, you'll have to specifically state principal on education loan is not an allowed deduction. Only the interest portion is allowed. So this has to be clearly specified. So how much is interest? 55,000. So 55,000 is eligible. So my total chapter 6A deduction is 128, 178, 183. 1,83,000. So my net total income is 422,900 minus 1,83,000. So it is 239,900. So this 239,900 becomes your total income. So now what does the question require? It requires only to compute the total income, not the tax liability. Of course, even if the tax liability is there, it is nil because it is less than 2.5 lakhs. So the total income, the net total income is 2,39,900. So that is what is taxable as the thing. So this is all for this computation. So now let me just summarize for the exam perspective. So first read through the question. Just keep marking what you need to add, what you need to deduct, what you need to adjust with the number of times you need to do. As you keep doing one by one, start doing with the head by head. So start with first head, second head, salary, house, property. Go ahead at a time. Start solving one by one. Start removing those whatever you have completed. Just start ignoring. Compute the total income at the end of the day. Then start with deductions and other things. Work on the deductions. Deductions must be in order. So maybe when you're doing the question, you can write the section relevant deduction section so that you take that order and close off it. So then you finally do it, arrive at the computation. Make sure, check the question whether it requires only the income or the liability. If it requires the liability, then compute the liability. Otherwise, don't do. Any extra step that you're doing for the purpose of examination will only reduce your total time to solve other things. So restrict to what is actually required. Don't go beyond that. So that is what I would like to suggest with respect to thing. So with this, we will wind up today. So in the next session, we will continue with more problems and more practical tips for your examinations to solve. How do you work out this computation for the examination? So that is there. Before, just I'll see whether there's any question that is vital that you need to answer. Yeah. So I guess that's it. So for dividend, should it be exempted? Charu has requested whether dividend should be exempted. As I told you, dividend declared in previous year 1920, received in previous year 2021 is exempt, or in specific, it is exempt up to 10 lakhs. But if the question is not specific about the date of declaration or date of provision, you can treat it as a taxable income. So I guess that's the overall question. Other things, I guess I myself explained it. So thank you all. So we'll meet in the next session on 7th, and we'll complete the rest of the computation and give an exam perspective of how to solve the problem. So thank you very much for everything. And once again, thank you all for the Teachers' Day wishes. I'm very happy. I'm very glad that you are wishing it. Thanks a lot. So thank you, guys.